In November 2016, the Financial Conduct Authority issued an interim report on its study on competition in UK asset management. It may turn out to be a watershed moment in UK investing. I've been talking to the former fund manager, Alan Miller. Alan, like me, has been campaigning for several years for greater transparency in the investing industry. So what I asked him was his reaction to the FCA report.
We just didn't know what was going to appear, and when we read it, we were just amazed at how thorough it was, how detailed it was, the incredible number of insidious practices across the whole industry, basically stealing money from the public's pockets. The regulator has shown these shoddy practices that pervade the industry, that it realizes it can no longer listen to the pure, misleading, total nonsense that has come from the investment industry, trade bodies, and actually do the right thing. And doing the right thing is the best for consumers, is the best for investors, and actually it will be the best thing for the industry.
As Alan says, the FCA report is very wide-ranging. I asked him to pick out what, for him, are the most important findings.
If you look at all the research over many years, what it has consistently shown is if you actually pay less, you get more. And that we've shown consistently, and the report proves this, that actually the average active fund does not add any value at all after charges. In fact, it actually goes beyond that in the report. The average active fund underperforms by 0.6% per annum. What the report again shows is that whilst you may have a chance of winning in the first year, by the time you've rolled out and invested over 10 years, the chance of actually kind of coming ahead and beating the market is very low. And the longer you invest, the lower the chances are. The report shows that the average active fund traded at 100%. Now again, that's more than double what the trade body said it was in their recent report. And then we have the hidden costs and charges. So all this trading adds lots of charges. And you can see it in the back of a financial statement which gets sent out once a year, which hardly anybody reads. And we've said again, we've shown in our research that added about 0.4% of the costs. Well, actually, the FCA has gone beyond that. It said that average hidden cost is 0.5% per annum. Now, 0.5% may not sound a lot, but if you're paying a headline fee of typically 0.75, you can see it's more than half just on that headline fee, let alone all the other charges. So the FCA has looked at the Morningstar 5-star ratings. It's awarding of funds for gold, silver bonds, and it has shown actually those gold, silver and bronze funds do not actually beat the market after costs. So you might as well look at the Morningstar Wooden Spoon Awards in the future, because it shows those 5-star ratings really do not show you anything. And then you have other insidious practices. For example, I'm not sure many people realize there's a lot of funds that have a thing called a dual price. So when you buy or sell that fund, there's a kind of bid price and the offer price, and that's called a dual price. Now, you would have thought that actually, if people were buying or selling the same fund on the same day, the fund management group would simply basically cross it between the two parties, and both parties benefit by not having to buy or sell securities in the market. But what some of these fund groups, it shows in the report, have been doing, is they have been crossing it between the two parties, and they've been taking a nice margin out the middle. Now the FCA has found that that practice is apparent in £109 billion worth of funds. Now we've written in our last report that just 10 funds alone, 10 larger funds, we showed the figure was actually, again, not hugely different to that. I think it was about £130 billion. So once again, the FCA report has backed up the principles, the numbers that we've been saying for years. We have the platforms that are incentivized or don't seem to be interested in passive funds. We have the advisors that seem to be more reliant on past performance and reputation than actually kind of combining risk, return and cost to actually, in which passive funds win out by quite a long way. The pension fund conflicts of interest are off the scale. In fact, there's one part of the report which is the equivalent of turkeys for Christmas, where the FCA has said that there's evidence that pension fund trustees do not act in the way of smaller schemes coming together, which would be hugely beneficial for the actual pensioners because they realise it might lead to redundancy.
There are then many lessons to learn from the FCA report. Alan Miller says every investor should read it.
It may take quite a while, but the amount they will learn, the gain they will have, the advantages they will have when they actually either invest themselves or through their advisor, and actually seeing what to look out for, will save them thousands and thousands of pounds.
For investors, there's never been greater access to information, and the financial media is as distracting as ever. Regis Media helps advisors produce great content, whether that's video, podcasts, graphics, animation, or written articles. It's about educating your clients and being transparent about how you put their money to work. Let's help investors tune out the noise and focus on what's really important.